I like that.
Yeah, people when I moved here, I just moved to Austin recently.
Yeah, that makes sense. Like fire. Because I was chair. Because they do it, you see it next year.
Right.
And that was great. That was because I was really, actually, I was the best people there, so I really loved that.
That's awesome. Yeah.
No, that was a great conference.
It was good. And Baltimore was a nice location.
I like it. Yeah.
I know, it's Tulsa was nice. It was good. I'm actually impressed with Tulsa. It's just a mystery. It was very fascinating history.
That hotel's
Yeah.
cheap phones. Yeah, but I really,
Yeah, so it makes it life easier though. When I don't want to do work, I leave the work from at home.
Segmentation.
Yep.
I believe semi-retired. So he's not teaching anymore. And now I think he's like just, an advisory capacity to the program.
And it also keeps some accounting stuff simple. So work stuff is on a work phone that's paid for by work. It's personal. Oh yeah, absolutely.
So it's documented this administration. My field was, or my dissertation topic was on collaboration and factor that leads to high quality.
On the management side.
Yeah.
Oh, that's awesome. Yeah, we're always looking for others, especially essays.
Yeah.
Your essay for fun. Yeah, definitely. Send me a
I will.
Yeah, I just got done with the interview. So I was associated as this year's summer. Now I'm not having to worry about scheduling. Yeah, Harlan's coming back to you. Harlan's teaching for us now. Yeah, I knew he was familiar. And I remember, I presented a paper.
You did, yeah. It was a panel on evidence-based research.
I remember that.
Yeah.
That's very cool. Yeah, well, good. I'm glad to hear about it. So, what do you do to essay?
So SAIC is a member of the Capital Project, part of the whole defense simulation piece, and so I volunteered to be part of our office here.
Oh, nice.
Yeah, so it's been a lot of fun. We really are enjoying it.
That's perfect.
Yeah.
Well, and yeah, there's so much going on here. It's great. Evaluating the whole everything. Between defense, capital, values, and the last of what I'm
Looking forward to getting involved. I'm going to support WC, but I'm not teaching full-time, so I have time to
That'd be great. Okay, well, I will definitely get you out. Because we're in the middle of accreditation and like essays are really important for us.
Perfect.
So, all right, that's good. Good to know.
That's fun. Ron, stay around. Nice to meet you. Should we go ahead and get started?
Yeah, let's get started. I don't know when people are running late. So
All right, no problem. Hey everyone, so I'm David Altounian. This is my first time doing this, but I understand it's first time for this as well. So first time doing this event here for this. Yeah, like that to see. Yeah, I know, right? So this is a deck we just did, I think about 2 weeks ago for UT Student Entrepreneurship Accelerator launch. So I just kind of brought it back out for this. So the forum for this can really be up to you guys. It's about 10 slides. I go through 2 pieces. It's very practical. It's not academic, so I'll tell you a little about my background in a minute. But the first part is about how you build your financials and what's important as a startup. And the second part is a little bit on funding. And I have a slide, I have a PDF that I may be able to figure out how to get to you all, but you can take notes off it. Of a project we're working on. It's an update to a report that we published of myself and 2 other co-authors, one other co-author, last January of the venture capital and funders in Austin. So if you're looking for angel groups, pledge funds, VCs, debt, I have a list. And it's grown quite a bit since January of 2017. So I've got that. We're in the middle of updating. Why I'm a little nervous about giving it out is because we have to go back to each of these VCs that we've added, or we have to find a way to cite where we got the info from. Otherwise, there's a liability that I'm going, you said we only have 25 million, but we really have 50 million. So we're in the middle of collecting that data. So we're a little nervous about it. And now there is 3. So I don't know if any of you know Mark and Nathan. Mark Nathan is the third one that's added. Steven Strauss, who used to be with AV, who a lot of people know. Steven and I did the first one. And maybe during this I'll give you a little background because it started with an argument and ended up with a really great research project. And then Mark joined this year to help us kind of do the update. So does that all make sense to you? So we'll start with the first part. The other part I'll tell you is that everybody has opinions on this, on both of these subjects. There's a lot of religion about should we care about financials, should we not, what's a good VC, what's good money, what's not. And I'm going to try to share both sides of these things. My view is the only academic part will be that I believe that we should tell you everything, explain why people view that way, and then you decide what fits for you. In some cases, lean startup approach to financials will be fine. In some places, you're going to want to do much deeper dive on your financials, and I'll explain what that is. Does that make sense? If you have other thoughts, other questions, please, let's make it interactive. All right, so I want to explain first of all this whole thing about lean startup versus traditional planning with financials. There is this common theme of financials don't matter and financials never survive first customer engagement. Has anybody heard that? Steve Blank is the champion of that. I know Steve, I've met Steve. I wouldn't say I'm a friend of Steve, but I'm an acquaintance. I know him, I met him, and I've been involved in lots of arguments with Steve. The reality is this is true, but the conclusion is BS. If you use that conclusion, your first product set assumptions are never right. Your first customer segmentation sets are never right. All of your assumptions are never right. But it's the equivalent of saying, I'm going to build a product, but I'm not going to worry about what features. I'm just going to start building them together. Even if you do agile or minimum viable product, you at least start with some assumptions, and then you build and create. So, while we can say that, Cam, everybody knows Cam Hauser. Cam and I love each other. I do judging for him. We use 3-day startup on campus. He's a true lean startup guy. He's like, financials. He actually came by here many bases, and I realized he saw my title. And I do believe there's a place you don't need to go to the depth. Now, there's a big difference between doing some financials and spending months and lots of money building very, very deep financials. I just talked about you. And so, we want to think about is, what is the right level of financials to get me to some milestone? That's really the most important thing. Here's the other thing. There are venture capitalists and investors that if you come in with a very complicated, or even with real numbers, what you consider real numbers, you will lose credibility because they want to know the story. I tell people this all the time. If you pitch on the West Coast, they want one thing. Pitch on the East Coast, which tends to be much more financially driven, they want the other one. I did this when I was, we go back a step. I spent about 35 years in tech. My early part of my career was working for a software company doing M&A inside the company. And then I went to Compaq, Motorola, Dell, and then I started motion computing in 2001. We raised about $65 million. So I went from at Dell, I started workstations division for Dell in Europe, Middle East, and Africa, which was really fun. It was doing a startup inside a big corporation. So I went from actually being involved in the acquisition of companies to actually having to run product, to launching products inside corporations, and I left and I started my own. When I went to pitch, when we went, because I had a few co-founders, the CEO and I, so I was chairman. He was CEO and I was COO. I funded the seed round out of my wife's and my pocket, about $500,000 because it's hardware, it's expensive. But I had never, ever done true entrepreneurship work until I started Motion with him. I had always been in corporations. I had no idea how to talk to VCs. I had no idea what to do. So I got somebody that knew how to do that. So we did our first tours, and when you go to the West Coast, if you show numbers, they go, that's all BS. No one cares about that. Get rid of it. Tell me who has the problem, how big the problem is, and how you're going to solve this great problem better and faster and make billions of dollars. That's what they want. They want to know the story of the pain and the solution. But if you take that to Boston or New York and you say, this is Andy. Andy has this problem. I solve this problem and there are 10 million Andys in the world. They're going to go, thank you very much. Show me the free cash flow. What's your valuation? I want to see your cap table. Anybody experienced this yet? Anybody gone through and pitched? Right? And so the answer isn't to do one or the other. My suggestion to people is always to have both. There's a lot of value to lean startup. There's a lot of value to getting out in the field, validating, building minimum viable products, telling the story, creating the passion. There's also a lot of value of having enough financials that people understand the size of the opportunity. And not only is it nice for raising money, but so many entrepreneurs give away their company because they haven't done the basic financial forecasting through a pro forma to realize that it could be a really big business. And they're taking money without having any idea of the true value. So, this common fable is BS. It's really great for press. It started because the people on the West Coast, there's a lot of people spending time building 50-page business plans and raising a bunch of money that for products customers didn't want. There's a great new documentary coming out. Actually, we did a panel on because I worked with them when I was at Motorola, called General Magic. And most people have not heard of General Magic. Who's heard of General Magic? Can you say what General Magic was?
So General Magic was a startup that failed. They kind of came up with one of the ideas that eventually turned into other stuff like the iPhone.
Yeah, Android, iPhone, iPod, streaming, emoticons. So both the Apple Watch, eBay, all of this stuff came out there. But the problem with it was raised a bunch of money from a lot of different people that had different competing needs and could never get a great product out the door because everybody thought about it. And they didn't really understand how much it was really going to be worth. So there's seats up here. Or you just sit up here.
I'll take it.
So it's important to understand those pieces. It also gives you, doing basic stuff, it gives you basic info that will let you plan how much you really need. So the other problem is, how many of you have raised money before? Anybody? How many of you raised money and then run out of money that you've raised before you got to? How painful is that? How much more do you have to give away if you don't raise enough the first time? A lot, usually a lot. As a matter of fact, in my company, everybody got crunched down by the C round. The company raised $65 million. Was around from 2001 to was sold in 2015 to Explorer, which Explorer has now been bought by Zebra, the barcode system. And all of the early people up to the C round, basically everybody got crunched down except for the suppliers and debt holders at the end, because it did not raise enough money in each round, and every round got progressively worse and worse and worse. And we didn't really understand at the time how much capital it was going to take to do that kind of business. And so it wasn't until our later rounds we got smarter and we raised a ton of money. But everybody in the early phases, we were learning. They and we all got the punishment of it. Now the side note of it is I got back there. I got brought back by the board as a CEO for 4 years, and I got paid, so I got it. I moved back up in salary. But it was a painful experience for everybody. So this is why it's important. It's just important to keep those two in your mind. Both of these things have value, but you're crazy to raise money without having some baseline financials that you understand. Here's really the steps. People get freaked out by financials, and honestly, it's not hard and it's fun. You got to figure out how much you need. This is not in order. You got to know how much. You figure out how much you need. You got to figure the best type of funding for it and who is the source. Get the terms for a good deal. Develop a strategy for engaging investors. Identify the targets and who those will be. Present the opportunity. Get a term sheet and execute. It seems really easy. All of the stuff before that's predicated on understanding your financials. It all starts with determining how much is needed. This is the first step in getting funded. How many of you have been in a situation where you sit down with potential investors and go, how much are you looking for, and what's the post-money valuation? Have you had that experience? Yes, no. How many of you had good answers for that? You had one? Did you do your financials all the way through? Did you do so? Yeah. How many? If you've done financials, it's pretty easy to know, right? If you've never done financials or you have nothing, and I get this question when I do mentoring here all the time, how much should I ask for? And how much should I give up? It's like, well, show me your financials. Well, I haven't gotten there yet. Then don't ask for money. Because I'll tell you, you should ask for $100. I'll give it to you on 100%. Say, well, that's stupid. Well, so is asking for money without having some idea of how much you need. So this is really what you need to start your fundraising. And this is why I go back to my earlier premise. If you are going to go raise money, you've got to do some basic financials. It's absolutely critical. And any of these people that tell you you don't have never really raised money or have never had a positive outcome or they were just really lucky and bring them on your team right away because you want their luck. Because you can't do this well. You can't raise money well unless you know this. So I said it's super easy. There's only really 3 points you need to understand. If you understand these 3 points about your business, you are done. You know what you need. The first point is, and you build your pro forma, if you don't know what pro forma is a projected profit and loss statement. And I'm going to show you what that looks like. It's revenue minus your expenses gives you your gross profit. Well, it's net profit because your gross is up above. But there's 3 things you need. Startup costs. How much cash do I need to get to my first revenue, to my first dollar? If it's service that you have, how much money do I need to get my first paying customer, my first billable hour? That's not paying customers, not your dad's business saying, Dad, come on in, next week you can do something. No, it's your first real dollar bill. That's your starter cost. The next one is the break-even point. When does the revenue equal the expenses? Why do you guys think that's the most important next piece? What happens at break-even? Well, at break-even, no, you don't have a profit yet. What is it?
Yeah, you can keep operating without depending on other money.
Right, you don't need any more money. No way do you need more money. You can just keep running it, even break even forever. At that point, you don't have to raise money from anybody else. This is also why when someone says, and you'll see this, if anybody sees a startup financial from somebody that's done this, and you'll go, well, your salary looks really low, your salaries look low. They go, well, we're not going to pay ourselves. Okay, but when are you going to start paying yourself? When we get profitable. Well, I don't see it on there. You better put it in there because you're going to get to break even and you're not going to pay yourself. If you want to work forever for nothing, go for it. But it needs to be baked into your plan. And it happens a lot. You guys be surprised how many of these I see. It's okay to take no salary. But as you're projecting out over 3 or 5 years, at some point you want to pay yourself some good money. And to say I'm going to hit break even without paying myself is not a realistic thing. But people do it. Well, that's why you will see entrepreneurs that have been around in their business for 3 years not making money. And you see divorces and things like that because this is, basically, Josh runs by that t-shirt says, I help people quit their jobs. And yeah, so basically you're unemployed, working really hard and making no money if you're an entrepreneur that's not paying yourself. You can ask something.
Yeah, so that break-even point, there's plenty of companies that will operate for about 3 years and they will not hit that break-even point at that time, right? So if you're looking at a kind of longer-term break-even, and maybe you'll get to this, but how do you kind of work that in with each other?
You are so awesome because that's actually why this next one, that was a perfect transition. The general wisdom that you hear is do a 3-year pro forma. That's what you'll hear all the time because there was this assumption that at some point in traditional small business startup world, if you're not profitable in 3 years, you shouldn't do the business. But in the world we live in, it could take you 3 years to get to break. It could take you 3 years to get to your startup. Anybody here doing hardware or doing something that's pretty aggressive like defense or pharmaceuticals could take you 5 years. You can't even get to here in that time. So what is important is the 3-year pro forma really should be done through your break-even point. What you want to know is 3 years of profit. So what I think about when people say how long, it's like, well, how long do you think it's going to take you to get to break even? I think I can get there in 2 years. Okay, do a 5-year pro forma. How long is it going to take you to do, to get break even? I think it's going to take 5 years to do a pharmaceutical. Do 7 years, or do 8 years. 5 plus 3. Why? Because once you get to your break even point, all you really have to do is, if you want to do just a really quick one, is figure out a growth rate. Apply it to your spreadsheet, hit a button, and at least you have a starting point. You can go move. Once you get to the break even, calculating the rest becomes a strategic strategic decision. This 3 years of profitable becomes, okay, now when do I want to put in a new product line? When do I want to hire more people? When do I want to give myself a raise to $500,000 a year? You know, you put all those important, you may start with $500,000 a year first and then product, but you think through it. But that's a great question. Most people will do 3 years, and a lot of times I will see pitches from people that show the 3-year pro forma, and they're still losing money in year 3, but they're going, but look, we're like close to break even. Well, why am I going to give you money to put in to lose? What would I get out of this? Where's the, you know, I need to see where it's going to have some return and some value. So that's the third piece is, what will the net income look after 3 years of profitability? What's interesting about this and why that becomes so important is this is where you can start gaming through strategy to figure out how big of a company you want to be. If you do your 3 years after profit, after this break-even point, and you go, you know, after 3 years I'm only generating $20 million of free cash flow, well, there's a lot of things you can do to do evaluation. You can do Black-Scholes valuation. You can do valuation tools just like you would use for an existing business. But you could also play around and go, you know what, 20 million free cash flow isn't going to do it. I probably have to invest more here. You know, maybe I need a little bit more runway. But you're starting to make business strategic decisions if you think about it this way. And I'll go back to what I talked about at the beginning about VCs. If you're on the West Coast, and I don't know how many people have dealt with VCs, but in my mind now, after 20 years, I know there's 2 different types of VCs. We have a lot of the first one here. Operators that become investors. People that have been successful as entrepreneurs, successful in the industry, made a lot of money, really good at raising money, and they come at it from the business standpoint, the operator standpoint. Then you have the traditional institutional investor type. You have financial people that are looking at this as an investment class and really only look at it in returns, in terms of return and risk. Those are 2 different groups, and they both will live in the same place. So it's important to think about these projects and your financials, understanding that those are the 2 things.
Can you talk a little bit about the first one? I've seen, we are in this boat where we've hit first revenue,
Yeah.
but you know, it never is the rocket, right? It's like, okay, well, we got to figure out market fit, we got to all this stuff. So
Yeah.
we no longer can sell the sort of dream.
Yeah.
We have to now make up for like what our actual track record is.
Yeah.
And so what do they want to see from a financial standpoint after that?
Yeah.
Is it still just break even in 3 years?
Yeah, well, so what they'll want to know if you're here but not here yet, they're going to want to know how long to get here and what are the steps you're going to do to get here. And then from that point, you just project out your 3 years plus. It's funny you said about dream, because when I was doing my second company, I tagged Carl Everett, who I saw last night, who was an Excel Partners partner and a former Dell guy, who was kind of mentoring us all the way through. And we went and pitched him early on. He said, you know, I'll help you. So about a year, he coached us as we were building our plan. We launched the product and did great. We went back to raise money, and he said, yeah, I took it to partners. We're not going to bring you up a partner meeting. I'm like, what? You've been involved? He goes, yeah, but you were selling me the dream. Now I see the reality. I'm not going to go take you in there. It's like, oh, crap. So there is something about the dream.
I've heard people put off revenue for that specific reason.
Yeah, you put off getting to revenue.
Getting revenue.
Yeah, because if you haven't figured out, I think this is a really important point you're bringing up. If you haven't figured out the revenue model that's going to get you the hockey stick, then you're probably better off continuing to invest and try to figure out what that model. This is where lean startup really kind of helps of, you know, continue to try, run your experiments, keep moving until you can get to a point where you see break even, and then you can project out where you're going to grow. There's nothing wrong with being there, but you just gotta, you know, again, I'll go back to the early roadmap. If you aren't thinking about this part, you could do this for 2 years and never get anywhere. You've got to have some experiments that go, okay, I think I can get to this. If I change my segmentation, if I change my pricing, if maybe I have to tweak my product, whatever it is you have to do. And each of those comes with costs, right? So you have to also keep thinking about how much more do I need to get to here. It's definitely an iterative game. It's not like as easy as just, yeah, here we go. But what happens is most people don't even do any of this, or they go all the way to this, and they just assume this is all going to happen. And you really do have to think about, okay, how do I get to my startup, to my first ship? And in your case, sometimes first ship, you can see pretty quickly that you have good product market fit, and all you need is money for fuel to market to get to big segments quickly. Then you can calculate a break even that says, look, if I raise $2 million, my break even moves out a little bit. But if I raise $5 million, I can bring it in, and my ramp to my 3-year goes like this, and that's it. The other thing I will tell you that's related to this is, I always say this political arguments, this is one. In the West Coast, first of all, anybody run a big business? No. So I ran a $1 billion segment for Dell product line, and ran workstations. It took a lot of money to get it to. We got to $1 billion in about a year and a half. It took a lot of money because we launched it worldwide, and we put a ton of money into marketing. You go look at companies like HomeAway and go look at Airbnb, and you look at how much money Airbnb raised and how fast they dominated through marketing and through just saturating. And the other one I like to use is HipChat with Atlassian versus Slack. Slack started 8 years after, 10 years after. They raised a crap load of money on the West Coast. And they used that money for 2 things, marketing and hiring engineers to quickly match what HipChat did in terms of their integrations, and then do more integrations fast. Capital is the fuel for a business's growth. And so, you got to think about more capital can get you here quicker than less capital. But if you're too early, you don't have a good thesis, you give up more money to get there. And this is why there's always this argument, should I raise money on the West Coast or the East Coast, or in Austin? Well, the West Coast will give you a lot of money on a dream, where here, because we don't have a lot of follow-ons, our investors in Austin tend to be much more conservative, and they want to see milestones and steps. So I'll give you $1 million now, I'll give you $2 million later. What we consider a seed round is not a seed round on the West Coast. It's like a friend and family round. What we consider a seed, seriously, we consider a seed round here of $2 to $5 million is still in the friends and family. So you got to understand that trade-off. Look at this. Does this all make sense? So why is it important? When you're doing the P&L kind of an overview, it forces you to think through the revenue assumptions. There's really 2 big buckets you always have to think about: the revenue and the expense drivers. And expenses like, I always see people will go through, I've got my utilities in there, and I've got, here's my accountant fee and my tax processing, and here's stamps.com. Like, nobody cares about that. There's like 3 or 4 huge buckets. You'll have your labor, so your staffing, you'll have your facilities, you'll have your big capital purchases you'll need to make, and there's some pretty basic things that are going to drive it. If you're doing hardware, you're going to have pilot units you're going to have to buy. If you're doing software, you may have hosting fees you have to pay for. You're looking for the big buckets, and then you can make assumptions on the rest. Do some kind of a multiple. Say, okay, I know that this accounts for 75%. I know 75% of my numbers are labor, facilities, whatever. I'm going to put 25% adder on every number just to be safe. And overdo your expenses. You're way better off overestimating your expenses than underestimating your revenue, which is the opposite of what almost every startup does. They always overestimate the revenue and underestimate, I can deliver $2 million and I'm going to do it for $150. So what you really do see is you'll see, I only need $30,000 and I'm going to deliver $1 million business. And then you go look at the numbers, like, we're not paying anybody, you're doing it out of your house, and I'm not going to give you money for that. Why would I give you $30,000? That doesn't make sense. So you really want to think about this, and as you dig through and get serious on those things in the pro forma phase, you will be surprised how much it forces you to make sense out of all of business. Because as you're going through revenue drivers, you should have some sort of customer segmentation, and you should be able to think about your revenue through the eyes of your customer and their share of wallet. Just had this conversation doing office hours the other day with a SaaS company. We're going to charge $300 a month for this SaaS product, which does about that much of probably what a corporation needs. Unimportant in this percent. But I said, well, how much does your customer usually spend on a month per cents. Well, I don't know. We probably should figure that out, because if most companies in your target spend a maximum of $500, and you say you're going to get half of it or more, it's not reasonable. And so it forces you to go dig through and go, is this revenue assumption reasonable for the customer segmentation? So one of the things I always tell people, I tell my students is, you need to look at your pro forma, not as something to get funding or you got to do because it's just expected. Look at your pro forma as the heart of your business. That all of your decisions, including simple things like feature decisions, should come from, because they drive costs and they impact revenue. And if you don't think about it from that, and I'm coming from a person that, if you talk to Scott Eckert, who was our CEO, he would laugh. Because when we worked together in 2001, I was the anti-numbers person. I was like, I never saw a spreadsheet that I liked. I've only become this way because I lived through the experiences of all of this. And it was only after time going, God, probably about 3 or 4 times doing if I had done this work in the beginning, this would have made decisions so much easier. I'm telling you now. So you've got to reorient your thinking about your pro forma. Not that it's a nasty thing you got to go through, but that it's where you capture all the decisions in numbers. That's the best way to think about it. Every decision you make, you should be thinking about, what does this do to all 3 of those? For example, we have this conversation all the time. Should I bring on this executive or this engineer? Okay, understand your customer need. Now let's go back to the spreadsheets. What does it do to your startup costs? In his case, he's already shipping. How does it affect your break even? Does it increase your trajectory? Or would you be better off spending the money on another salesperson or on more marketing? Those are how you should drive decisions. In corporations, that's how decisions are made. In a startup, they can be made the same way. The only difference is you don't have historicals to go off of. You have to go off of your gut. Where in a business, I can go and I can say, look, if I add an engineer, I know I can bring in my time of development by 2 months. Or if I bring in a salesperson, it's $1 million of revenue for every salesperson. I have historical data. You don't have that. You have to make assumptions. But other than that, the mechanism of doing that is just as important. Once you have these understood, the rest of the spreadsheet's all Excel's work. You don't have to do anything. You hit the number, it's going to tell you, yeah, wow, you're making a lot of money, or no, you're not making money for a long time. But it all comes off of that. Now, how many of you have done this at some level, and you don't like the number, and you go through and you just start turning around? And that's a very common thing to do, but you know in your heart and your gut, it's not realistic. And the problem is, and this is why this is tied to the funding discussion, if you sell your investors based on that assumption that you know is not true, you will pay the price later. It's just really painful. Other value of this, big one, it helps you determine the risk areas of your business. You will find periods, you will find things that is working through these assumptions. It's like, crap, I'm not sure if that revenue per customer assumption is correct, or man, we expect to get a lot of money out of that segment, I'm not sure. The one I love all the time is no one puts any money down for space or for facilities, but in their projections they're gonna have 20 people, in 3 years, and go, well, should you have a pretty big placeholder for your facilities and utilities, and which you can just put as one number if you want. Oh yeah, didn't think about that. So it makes you think about your risk areas and areas that are, know how much capital you need is pretty obvious. Estimated long-term value is what most people don't pay attention to. And again, you'll get more of this on the East Coast than you will on the West Coast. The East Coast people are gonna, I'll stop saying East Coast and West Coast because it's a bias. Financially driven people are gonna wanna use this to determine. Operations people are not gonna use this because they're gonna assume if they become your investors, they're gonna be really smart and make you better than you are. So if you said you're going to be worth, $50 million in 2 years, with their brilliant operations, you're going to be worth $200 million. That's just the way. I'm telling you, because I'm more on the operations side. That's how I think. And I know my friends. That's we don't look at our investments like a financial return. Because if I did, I would never invest. To be honest, y'all are nonprofits to me. It's just reality. The number of returns for startups is so low. I'm trying to think of his name. The professor from Willamette University has a big angel group. They're like one of the leading angel researchers in the country. He's been Rob Wilbanks. And he did a calculation that on average, an investor, angel investor, has to invest in, excuse me, about 45 companies before they see a positive return on investment. And you go, God, that's terrible odds. So why do people like us invest? Because we believe if we invest and we take a role, we're going to help the company do better and attract bigger dollars and attract those people from that side. The people from that side are going to do, they all have models. Every VC that's got that kind of capability, even Austin Ventures had analysts that had models. Most of them have their models proprietary to themselves because they all have their own sauce of ties to their thesis, their commitments to their LPs. But it helps you understand as well the long-term potential of the company. And then here's the other thing. It helps you decide whether you really want to do this. A lot of times people have in their heads, this could be a massive business, and you realize it's going to take you a long time. I actually think if enough people did the work early on pharmaceutical startups, they never would do it. They would just realize it's just such a hard slog. Luckily, I was ignorant when I started Motion. I was a hardware guy for Dell, and I knew all the suppliers and all that. I thought, I'll just bring it together, and we'll get it started. If I had actually done this, I never would have done it because I wouldn't have understood. I mean, I knew what the steps were, but I was so much from the operator standpoint. It's like, I know the people and I know that. We beat the odds because we all had experience. And we all had the suppliers that signed up. Intel helped us, Microsoft helped us, Dell helped us. But if I had done it on my own, we never would have been able to do it. It was literally one of those things where you go, okay, well, that was just a lucky confluence of the right people getting together. Because if we had done it, we would have said, and actually some of my investors and some of my partners would have said, they're not sure if it was worth the 14 years they put in, because they didn't get great returns personally. They got paid for 14 years. They got great, great personal satisfaction out of it. It's really fun to go to Disneyland and watch them walk around with your machine. But in terms of what they could have done in 14 years, they may have had a better return somewhere else. So this is why it's all important. Does this all make sense to you guys? Yeah. All right, so in every business, there's 3 key financial statements. The income statement, which is really basically a profit and loss statement, a cash flow, and a balance sheet. The only one you need to worry about is this one. These two they're only really matter when you're an up and running profitable company. At some point, even before you're profitable, if you go get a big VC round, you're going to end up having to do cash flows and balance sheets. But that comes into the category of, that's a really nice problem to have. And I will laugh because I'll see pitch decks or I'll see, you have your financials, and they've done this and they have both of these. And it's like, why are you bothering? You don't have a business yet on these. I don't care about your cash flow or your balance sheet. In the startup world, what's probably closest to a balance sheet you would think about is your cap table. How much debt and who are your shareholders, and how much, what are their terms, what's the percentage, that's it. And honestly, you can find people who do this. This really requires the founders to think through. This, or the cap table, your lawyers can do this for you. Go hire a VCFO. They don't care what your business is. They just need to know who gave you the money and what your term sheets look like, or what your agreements look like, whether it's a convertible note, most of them that's what you're going to have in this phase, a safe note or whatever. They're just going to build out a cap table for you. Do you do a cap table?
I don't want to.
No, you don't do it. You get stuck doing it?
Sometimes.
Sometimes, yeah. So, I mean, you really don't see anything except for it's right. So that's it. So this is the one you should spend your time on. Don't waste your time on these, is my advice to you. And really sophisticated investors are going to doubt your P&L if you have a cash flow balance sheet. They just don't believe it. So,
I have a question.
Yeah.
On the go back to the pro forma here. Sometimes when I look at companies' pro forma for some of the assumptions, they're so early, they use a lot of market comparables. And I know that's kind of like a great topic, but how do you feel about that?
It is. So this is a great question. When she looks at pro formas, they use a lot of assumptions in there, and market comps are a lot of things. Here's the deal, and it is debatable because everybody has an opinion, and so what you're doing when you build every P&L and everything you do, you should be able to defend them. Part of what happens when you're pitching is and this is where you see this here a lot. there was a term they used to use when we deal with Apple, I hate it, but I use it all the time because it works. They call it the bozo test. The bozo test is to ask questions they know the answers to, or they have very strong opinions about. If you don't agree with them, you're a bozo, and out you go. And a lot of the comparables are around bozo tests. You'll sit in these meetings, and there will be people, investors, that will go, where did you come up with that number? What's the assumption behind it? Because they built in their head that either the number looks funky, or they know more about that than you do, or whatever. You have to have solid assumptions. Someone says, well, I got this, I got this comp because I'm doing a networking device, and I looked at Cisco, and I looked at D-Link, and I looked at all these people, and which you'll usually hear about. You're going to say, you're no Cisco and D-Link there, but you still win the argument because you've done the comp. So you may get the grief, but that's better saying, well, I got it, sorry, but it's the best market comp I can get at the time. I'm happy to get more info. If you have an idea how to do a better assumption, I'll take it, but that's the best assumption there is. That's better than, I don't know, we just kind of looked around and put that number in. So all of them, you should be able to have some level of an assumption behind it. It could be that you get a supplier tells you something, you've done a market analysis, or you do comps. You just have to have a good answer that's, that you can stand up and support. And actually, one of the great things to do when you're doing your pro formas, you're getting them, is pass them around people in the field with experience and have them poke holes at it. Because if you can get friendlies to tell you where the numbers don't make sense, and you can back it up with assumptions or with some data, it's really great when you get in front of an investor and they ask that question. Well, it's funny, because you're not the first one that's asked that, and let me show you the places I pulled it from. And I will tell you one trick. It's a hard trick to do, but if you ever get in that position, there's a thing called triangulation, which is, one data point. Anybody heard that term? One data point, you may be close, but you're probably off. 2 data points, you're a little closer. But if you get 3 or more data points that support it, you're pretty close to your number. So one of the things you do is if you have a highly debatable issue, like no one believes those comps, go find some other ways to triangulate the data to go, well, I looked here, I got feedback from somebody else, and go, you're right, no one knows, but here's the 3 places I found it. I found market comp, I did a quick survey, and I asked 3 executives from the field, and this is what we got. Do you have anything better? And at least you're answering the question in a knowledgeable way. And I said the P&L should be where you test your assumptions, you land. It's also where you can defend your business, because it forces you to go find those answers. And frequently you're wrong. You're not going to be right about it. You're better off to know early. This is basically what we just talked about, revenue. So this is your gross profit because it's your cost of sales, your cost of your materials, minus your expenses, which gives you your earnings or your net profit. And they do this a little, for the free cash flow would be in that net profit line because it's after taxes. No one cares, it's close enough. What you really want to know is after your revenue and cost of sales for the materials and your expenses for the business, how much excess cash are you throwing off? That'll tell you a lot of things. First of all, it'll tell you I have money to reinvest to grow faster. I may not generate that much, but it'd be a great business because we can make a lot of money, we can pocket that and still grow the business. Or it may be that you got to do something different because you don't ever get to a point where you have great, positive cash flow. But this is really what it doesn't have to be super detailed. This one is kind of funky. I just pulled it because it was really simple. I was looking for all these examples. I would have more labor, facilities, maybe R&D. If you're a software, it'd be hosting fees, things like that. But you don't need more. If you get more than like 10 lines in expenses below, what these are called below the line expenses, these are top of the line expenses, you're too much. Yeah, you're putting too much detail in there for an entrepreneur pro forma. Because if you get to some level of specificity, it's like if we ever baked a cake, or baked a cake, and when they say it's like a 1/4 teaspoon of salt, how many of you ever gone like all the way through and you don't need to get to that. Get close enough. That's what this is. You're trying to bake a cake. You're not worried about whether you have every if it's 1/4 teaspoon of salt, do you even need the salt? You don't need that level of specificity. But if you leave out a 1/2 cup of sugar, your cake is probably going to suck. Yeah.
To that end, on like the specificity, and you mentioned, if you're talking to an investor and they're like, oh, where'd you get the assumption numbers? I disagree. there's this feeling of, especially if you're raising like at a pre-seed stage, it's like if you're having conversations that are like that deep, it's like, is that even the conversation you should be having at that stage, right? And so like I can imagine somebody being like, oh, you know, you have just these 5 buckets here, you didn't include this more specific thing, you're not a serious business person, you know?
Yeah, I know exactly what you're saying. It's a great question, because here, now you're talking about the psychology and the approach to raising money, and it works on both sides, for you as the entrepreneur and for investor. So if I'm doing pre-seed, and they want to dig down deep into the numbers, my first bet is they don't really understand what early stage investing is, which happens a lot here. On the other hand, just because you're going to pitch to pre-seed people doesn't mean you shouldn't have the numbers.
Right.
You don't need to show them right away, because you're right, they will say, you will get some people say, if you're that focused on the detail, you're probably missing the big picture, and I have heard people say that. Don't pitch this level of detail. Take it up to the highest level, and then when you get them on the hook and interested, go, and they start saying, well, yeah, we know about this, double click down. Yeah, we've done that work, let's show you. At that point, you've already got them interested. You're going to increase their confidence in you. Remember, a big part of raising money is getting people to believe that if they give you their money, they're going to get a positive return on their investment. And they're not looking for ways that you're going to reinforce their beliefs. They're looking for catching you in how they're not going to lose their money. People don't really invest that the other way out. Oh yeah, this is perfect. Matter of fact, most investors, if you really talk to them, and I'll take my feeling, or experience it, is once they say, yes, I'm interested, part of the period of due diligence is finding the excuses to back out of the due diligence, because they know they're on the hook for doing this, and they really, really want to make sure that the money they put in is coming back, so there's definitely a game. It's hard to do this backwards. And so, it's the right piece for the right audience is what you need. There you go. Does that answer your question?
It does.
And when you have the info, it's always easier to hide than it is to make it up if you don't have the info. But you'll also find when you're doing early, your assumptions are just really way wild.
Yeah.
But if you get the framework working right, then over time you're building it more natural. All right, everybody understand P&L and all that? Okay, I want to show you the 4 things, and this one came right out of the entrepreneurship textbook. I didn't give him credit for it, but it was my dissertation chair, so I don't think he'll sue me. The 4 things about businesses and people in the financial, that the financial world worries about is profitability, liquidity, efficiency, and stability. Profitability is what we just talked about. How much cash you throw out of the business. Liquidity is a very different thing. Do you have enough cash to pay your short-term obligations? And I will tell you, I live this one painfully myself at Motion. It's weird to be wildly successful and freak out that you're running out of money. And liquidity is literally, do I have enough cash on hand? And this is where your cash flow statement will make a difference when you start going. But it's important to raise enough money early enough to get you through those early growth stages. So a lot of times when I'm talking about the estimate how much money I want to raise, I'll get to break even. I'll do my startup cost point plus some percentage for misses, to support misses. And break even, I'll do some percentage plus a hedge for upside. Not because I'm not going to make money, but I may need money because I may not have enough money coming back from customers. So in the startup phase, to get to your startup costs, let's say it costs $100,000 to get to your first product. I may ask for $115,000, so I have a $15,000 hedge to protect the slips of the product. But when I get to the break-even cost, and I calculate to get to break-even, I'm going to need $5 million. I may do another 15% hedge. I probably will. Not because I'm worried about slipping from that, but I'm worried about getting paid to support my growth at that point, because you're going to start having customers paying. So I'll give you a real-life example. When we started Motion, we had a $2 million line of credit for our materials, they call WIP, which are all the parts that go into the factory. As a new company, you have something called, it's a real term, I didn't make this up, the liability of newness. The liability of newness is you have no track record, you have no credit history. No one knows you in the marketplace. Your suppliers typically will be COD or within 30 days. If you get net 60 days, God bless you, you must have like the highest credit rating in the world, because most businesses that are new can't get past 30 days, and most have to pay on delivery. Ours was mostly 30 days. But if you're selling to corporate customers, you don't get paid a lot of times till 90 days. So you have, from the 30 days that you have to pay your investor, your suppliers, to the next 60 days until you get your check, you better have cash. That's liquidity. And what killed me was, we launched our product, we expected to sell about 1,000 a month to start, because we were going to sell them ourselves. Then Gateway came up to us, Gateway Computers came to us and said, we want to OEM your product and white label it for us. We were like, yay, and they wanted like 10,000 right away to put in the stores. Whoa, that's awesome. And the supplier said, yeah, the problem is you have to pay us for all those parts. And they were about, let's make it simple, $1,000 a unit in parts. And our factory said, we can't build all these. And our customers that we sold directly were like, you promised these in 5 to 7 days. And we started getting this really bad problem of, we started shipping, so we negotiated, we started shipping like 500 a week, waiting for the money from Gateway to come in so we could pay to buy the more parts to keep the production going. And Gateway said, sorry, we pay on 90-day terms. It was in the contract for less. We're like, we negotiated 30-day terms. Yeah, but we pay 90-day terms, which is not unusual. Even if that's just kind of, Dell was famous for doing that. That's a liquidity problem. And people were like high-fiving all over, and people were going, congratulations on Gateway. And they won an award with our product. And I was thinking, God, I hope I can make payroll next week.
That's when cash flows, you want to do the cash flow.
That's when you need the cash flow. And so what we had to do is we had to go, luckily at that time, NEA had invested in us, which was a really big VC firm on the West Coast. And they took us to Silicon Valley Bank, and we got a bigger loan. But in between that period, we ended up having to do something called factoring, which anybody know factoring? And then the receivables go there. They take the money out that we owe them, which is usually very, I think we were like paying 15% interest. It was huge. When you're making 20% gross margins, that takes most of your profit, if not all of it, just to keep the doors open. So everybody's thinking you're doing awesome, and the reality, the bank's doing really well. And you're getting a lot of publicity, so that's liquidity. Does everybody understand? So the easy way to think of liquidity is, do I have enough cash on hand? And from a business standpoint, the thing that drives that is, how fast do I get paid by my customers, and how fast do I have to pay my suppliers? And if you can skate Dell's brilliance was Dell had negative cash conversion. I think they still have, not as much as they did. But when you order from Dell online, you put your credit card in, they put the money in the bank right away, then they bought the materials, they shipped it to you, and then they pay them in 90 days. They had all of your cash you're making interest on, and they weren't using their own cash. That's beautiful. That's negative cash conversion. That was the brilliance of Dell. That's why they did so well. Efficiency. How effective do you use your resources? This will become bigger once you get to the break-even point. This is just, are you spending appropriately for marketing, for development? And this is where comps are really important. You go look at other companies in your class. What percentage of their marketing is of their sales is used for the marketing budget? So is 20% of their budget, for a company that size, so 20% of budget is usually marketing in a company in your field. Go take 20% of your revenue and say, is that, or you're using comps, I'm not doing it right, but are you getting the idea? You're trying to make sure that your ratios of what you're spending for marketing as a percentage of your sales is the same as other companies do. That's really what efficiency is. And then stability is the last piece. That's debt to equity ratio. Debt to equity is, so I was one of these people that don't like credit cards, I don't like owning, I own my own car, I don't want to own anybody, I like paying interest, which it's perfect sense for you personally, but not really good sense when you're profitable, because what you don't use in debt, you're paying back in corporate income tax. So debt becomes important when you can borrow money and take that write-off, and you're using OPM, other people's money, to fund your operations. You have to fund your workflow. But if you get out of range, it's no different for a business than it is for you at home. If your debt ratio to your income gets too high for your credit card, your ratings go down, your interest rates go up. Same thing here. If you don't have any debt, your early debt for your corporation is going to be a high percentage because you don't have any credit. So you want to, once you get to break even, you will have the ability to do that. Or once you get to a point where you have customers that are paying you, you can do factoring, which is a form of debt, and you'll get a better ratio than if you don't have any customers or any opportunity. These are the four that are important. These are the two that are critical for startups. This is really critical if you have a product business. If you have a service business, this isn't as big of a deal because they're not going to necessarily turn off your hosting platform. You can pay a quarter of it there and let you go. But if you're building a product, you have to get parts from suppliers. That door goes down. And one of the things I found about, we had several thousand parts in the Motion tablet. It only took one to shut down the line. It was a logistical nightmare. And so liquidity is a really big deal. All right, forecasting approaches. Two different types of forecasting. One type of forecasting is top-down, unconstrained. It's my soccer. Unconstrained, what could we do? That looks at the total available market, the channel capacity. How big could this business be? West Coast VCs love this. Tell me how you're going to dominate the world if money was not an object. Bottoms up is using constraints, what can we really build? Our people here like these better. They'll say they want this, but here's what you'll hear. Your business isn't big enough, but if you show them this, yeah, it's not realistic. It's just awesome. So, same thing I said earlier, what do? Do both. Go, this is what I can build with the capital I have here. If I can be unconstrained, this is what I can do with my product. I really suggest doing both, and somewhere in the middle is going to be realistic. But these are two approaches to do it. And I don't know, I find that in my experience, if you're honest with the venture capitalists and go, look, I've done both. I've done a bottoms up and a tops down. They're going to have a better discussion. They're not going to go, what, don't you know what you're doing? They're going to go, yeah, okay, you're thorough. Let's discuss your assumptions. And again, just like in your P&L, your assumptions are really critical here. And having gone through lots of pitches, I know you've seen lots of pitches, assumptions can crater you in your pitch, both here in your assumptions in your forecast and your assumptions in your financials. So as you build your forecasts and as you make your assumptions, be precise and call out, here's how I got to this number, and then test it with people, and wherever people puke on your numbers, that's where you should go test your assumptions. And the better you do that, I always look at what you're pitching, it's like a final exam. And if anybody's pitch, this is what it is. They're looking to fail you, and you're looking to prove that you've done enough homework that you should get a C at least, but you really are going for the A. You really have to do that kind of work on it. Okay, so this is my last piece about doing the financials, and I'll do a couple on the funding. So one of the things that drives a lot of expenses is marketing and sales expenses. A lot of investors will ask about, the customer acquisition costs, what's the lifetime value? You've all heard those questions. Those are screening questions. Do you really understand your marketing and sales costs? And related to that, do you really know your customers? Do you really know the market? This is kind of the bozo test for a lot of investors. If you can't answer CAC or LTV in some way that they believe, you're done for a lot of investors. So you need to think about that. If you don't have it, and by the way, I'm on a board of a company that's fought it took 2 years to finally get to a reasonable number. The board of investors fought with the CEO and the team for a long time, but they finally got to where we have a repeatable business. If you can't get there, tell your assumptions about what you think is behind it. It's as much about the process you're going through and how you know your customers as it is the actual number. Accounts receivable, I explained why this is important. Even from the beginning, think about your accounts receivable terms. You want to know how long it takes you to get paid, and the payable terms, how long you have to pay for suppliers. I was talking to somebody the other day about this ability so it's a service business. And he's got a problem that he has lots of last minute requests, and his last minute expenses for his people, it's a cleaning business, so they do, what do you call it, they do vacation and corporate cleaning. And he was bitching at me about how he's not as profitable because he's got these big customers, and he'll get around the holidays an urgent request for party cleanup or things like that. And he's like, this is crazy. I'm like, everybody's happy, but I'm getting creamed. All my employees, I have to pay them double time to come in. I said, have you thought about doing a prepayment premium discount? And he said, what do you mean? I said, well, it works this way. If they actually pay you for a scheduled service, they get 50% discount. But if it's within 24 hours, they pay a 15% penalty. And if they just schedule like normal, it's in the middle. He said, well, why? Why would I do that? He goes, I hadn't thought about doing that. I said, well, first of all, if you just do a last minute penalty, they're gonna be pissed. But if you give them the pre-scheduled discount, you now have their cash, and they pay up front, that's the requirement. So they'll get 15%, but you have their cash. You can pay the spikes without a problem. When you have to charge them at the last minute, they're offsetting your cost for these last minute things, and everybody else is in the middle. And if you cut off those rough edges on both sides and you have their cash in the middle, you smooth out your revenue and your margin for the whole year. He's like, holy crap. What do you think about it? But I didn't think about that because I know his business. I think about it because of this cash conversion and these terms. His deal was, if I have to do last minute, my employees want double time. My customers are always bitching at me about discounts. Great, I'll give you 15% off. You pay me up. You book out the quarter, pay me for the quarter in advance. Now you're living on their money and you got their interest and you got some cash on the cash flow, you're in good shape. The ones that are normal, you're gonna pay normal. The ones that are calling you and harassing you, two things are gonna happen. Some of them are not gonna do it anymore and they'll just go on the regular schedule and clean up after their own party because they don't want to pay the premium. Or they're gonna call you for the premium, they know what it is, and they're gonna offset your costs. Both of those are good things. They'll pre-think and they'll schedule you before the last minute. So that's this is why I say you really want to use these as your center point. Any major capital that you buy, if you have hardware, if you have vans, you gotta really think about the replenishment time. Don't worry about depreciation. I mean, that's all. I'm like you guys, most of you probably are like this, but you see depreciation, it's like, I don't really care about it. It's not a good thing. Just totally fine. What I do care about is that this equipment only lasts for 2 years and I got to invest. And this is not a silly, subtle thing. We did hardware. Our plastic cases required tools. Tools were only good for like 20,000 shots of plastic before they had to be replaced. They were like 20,000, 50,000 a part. If you haven't planned for that depreciation of that replacement, that's a big problem. Use a 3D printer for your business, and you haven't figured out repairs or upgrades in software. If you're using a system that requires regular software upgrades, you haven't put those in, you will undershoot your expenses. You got to think about those purchases. And then, best thing to do, I always say, being an entrepreneur is about managing and reducing risk. You all know you have product market fit risk, you have operations risk, you have people risk, you have legal risk, you have regulatory risk, you have financial risk. Your job here is to use your spreadsheet to identify the scary parts of your business and not to paper them over and make up numbers, but to go attack those and reduce the risk of those. That's really what a great entrepreneur does, is they reduce risk. And that's really what you can use your financials for. That's it for the financial building up. Does that all make sense?
With something like if you're doing a recurring revenue model and you have lifetime customer value, and you're sort of pre-actuals, are there strategies? I mean, you can, I guess, with any of these, you can kind of try and look at comparables to see kind of how long you think they'll be around. But is there a more effective way to?
No, I mean, first of all, I think use comparables to start, and then you experiment and try. Some of this is have a learning curve of what it takes. But I think there's two things. You want to look at your recurring revenue. You want to look at your onboard rate, your churn rate.
Right.
You know, and there's comparables that you can go look at. And then you gotta test it to see if it matches.
Yeah.
A lot of this is, you know, you can A/B test your assumptions here, just like you can in marketing.
Yeah.
Try different things and see, so. Do you guys have that? Okay. All right, so why do you need funding? There's three major reasons why you need to raise money. Cash flow challenges, you need it for parts, materials, hiring. You know, you eventually run out of friends that will do this for fun. You know, so you're gonna need it for cash. You're gonna need it to buy equipment. And then you're gonna need it just to get the business to first revenue. Even if it's a service business, you need some money. You may need money just for the legal fees and for stamps.com and all that, but you know in all businesses, you need some of this. If it's a small amount of money, friends and family, credit cards, I mean, there's a famous movie, Hollywood Nights, it was done by a filmmaker, and he did the entire film. He didn't want to deal with the Hollywood investors. He did it off their credit cards. He just skated credit cards all the way through the filming and funded the whole thing off of the back of Visa and MasterCard. It was, you know, he figured out how to bring it in that low. So, but these are the three things you're doing. Three sources are personal funds. I put family and friends and personal funds. Equity capital and debt financing. When you take convertible notes, that's debt. Now, how many people know safe versus convertible? Anybody know what the difference is really?
There's no debt features to it.
No debt features. Well, that's the biggest real functional thing. There's no interest accrued on a safe note. It's also known as very entrepreneur friendly, where a convertible note is debt and it is investor friendly. But you'll hear the debates, oh, I hate safe notes, or yes, I only want to do safe notes. A safe note is equity. It's not a convertible, I mean, it's not a debt note. It's considered more in this class than this class. It's kind of a tweener, but because it doesn't have interest, it doesn't accrue interest, it fits up here. And it converts over to actual classes of stock, it's equity. So when people say, you know, I don't like safe notes, you should ask them why. If it's, well, I don't know, everybody doesn't like them, which is a very common thing, that's a terrible answer. The two right answers are, I don't want debt, or it's too favorable to the investor or the entrepreneur. I want something a little more balanced. So these are the three ways. A note about personal funds. I am not a fan, I'll just say my personal thing, of family. I've seen more families destroyed in relationships from borrowing and from getting investment from family members that probably are worth it. You always end up at someone's house for Christmas or Hanukkah or whatever. It really sucks if you have to stay in the other room because you owe them money. Equity, and this is going to be a bigger issue now with the change in the laws for micro fundraising and what's the other one? Crowdfunding. I'm also personally not a crowdfunding fan for bigger raises. I'm okay with crowdfunding for smaller businesses or certain types of businesses. Personally, I want as few investors in my business as I can. And the investors I want them to be value added. A lot of times your debt investors are truly value added because all they care about is getting a return. And they just want you to be healthy and happy. And I know that sounds silly, but you know, by the time I left being a CEO, I was ready to like pull my hair out. Maybe it's nice to say I was really ready to hang myself because I had early stage VCs, I had late stage VCs, I had a private equity firm. We had Intel Capital, which was a corporate investor. They were a big player in our late rounds. They had a big stick. And then we had two debt holders that we had on our board. We had a debt holder that did debt funding, debt financing. And we had the bank that actually financed our, about $10 million at the time, working line of capital. Our late stage venture guys wanted to sell the company, and they wanted a 2 or 3 time return on money. They were okay, they didn't care, they just wanted to return. They'd give back to their LPs, go to the next late stage deal. Our early guys, even though they were past their 10-year mark, were like, we don't want to be diluted, and they want 10x, but they would have taken maybe 5x. And our bankers were like, don't want you to do anything. Don't do anything that risks us getting our payment. Because right now, the interest rate that we can get by putting that market to work somewhere else is lower than we get from these guys, so don't touch the company. On the other hand, when I had a fight, I would go to the debt holders and go, I think they're threatening the life of the company. The debt holders would call the other board members because all they want is they want to get their money out. So you need to understand the mentality of your investors. And all I had here were friends calling, going, hey, we need to sell that thing. So these are the 3 different groups of capital. Okay. This is really my point.
So then how do you balance if your debt holders wants to sell the company to get their money out and you have strategic investors? So what is the
No,
trick?
debt holders don't want to sell the company. The debt holders want the company to have as little change as possible because what do they get? They get their principal and interest every month. That money sits there. And you know, now the only time the debt holders are paying is when the market flips. For us, it wasn't that way. So like if interest gets expensive, they probably want their money out because then they want to go and give it to somebody else, get a higher rate. But in my case, it was the other way. Because this was, I went back in 2000 and 2009. The debt all clamped down. Nobody wanted to touch debt anywhere. They wanted to make sure everybody was healthy. Nobody go away. Don't anybody move. There's no place to put money. But these guys are really sensitive to their return. That's it. You said, how do you balance it? It's really hard. You got to be really careful how you take the money in and how you build your board. And, it's not easy to do. You just got to be really thoughtful about it. I think the mistake we made was, well, first of all, we got too excited early on from our early investors that we're going to put a lot of money in. We're just going to grow. And the money didn't develop. To give you a little bit of a history lesson, we were one of the first tablet PCs for Microsoft OS for tablet. So our investors were super excited, Gateway OS, their product, put a ton of money in. We went worldwide really quickly. We ramped, and grew. And then Microsoft couldn't make up its mind about whether it was going to do convertibles or 2-in-1 notebooks or tablets. And we were the ones that were all tablets, like Surface later did. And the market did this. And in the meantime, expenses, because we had a big whip, we're still growing. We still had a service. And so we took on whatever capital we needed at the time to get us the next thing. We took on the next debt that got us more cash headway. In retrospect, you can go, well, that was stupid. You should have had a better strategy. But if any of you have been in the middle of that kind of crap, you just want to be able to make sure you get to the next milestone. You'll figure it out then. You don't want to like leave your customers hanging. You don't want to have to lay off people. I mean, you'd like to think that there's more logic behind it, but it's not. It's really about how do I get to the next stage. And in the meantime, we still thought the future was we were going to continue growing and expanding. We just needed more cash. So that's what it is. So there's not we were profitable, we were there, but we were growing. But it's just hard. There's not an easy answer. Every company's different. But there's a ton of nightmare stories of boards that have that, and investors that fight, things like that. As a CEO, you just got to deal with it. How did I deal with it? I went and got my PhD. I turned it over. My COO wanted to be CEO. I'm like, really? See ya.
I'm curious, you said that you had some debt holders on your board.
Yeah.
Debt financiers,
They insisted on it.
Really?
Yeah. So again, remember the time we raised that was in 2009, and that was the debt crisis time. And so they're like, at that time they're going to put their money in, but they're going to give us a line. They wanted to have some level of control of the board.
Sounds like it's a good thing for you.
Well, they got us through the problem because the company got sold in 2015. And it grew. And the honest to God truth is, the company was doing fine. It was growing still and all that. But it was Groundhog Day for me. I'm more of an entrepreneur, and I want to go teach. And I'm like, I can't do another quarter. For me, it was like, are we going to make it over? It's this, loop of, oh, we had a great quarter. Oh, crap. I'm never going to get over this hump this time. And I made it a good quarter. And like after 4 years of that, I'm like, I like being the COO and the CTO. I didn't have to see this. I didn't have to have the calls from all the board members. So at the time we went back and forth with Panasonic for 1 and 2 in the world, and they had way bigger pockets. They kept trying to kill us, which all took money to kind of fight over. So it was really, it was a great MBA.
So help me understand, you were talking about the differences between safes and convertible notes of debt and equity. That really doesn't matter once you get to the first equity round anyway, because they all convert.
Right,
Why do you care?
Well, because they're in a convertible note, they're not forced to care. They're not forced to convert. they can take interest on it. They can leave it and stay at the top of it. So this is a really interesting and good question. I don't know if you know, but the way there's liquidity preferences, there's also liquidation preferences. Liquidation preferences, I believe it's taxes first, then employees, then debt holders, then the last in the stack for investors all the way down to angels and your founders are way down the stack. So in a liquidity event or a liquidation event, debt holders have to be paid off. So that's my
Another big difference.
Sorry, my way over.
Just to point out, another big difference is that safes don't have a fixed timeline.
That's right.
Whereas the debt feature on the debt instrument will, and so that's one more reason why it's more favorable for the investor. It's because it kind of lights a fire under your ass.
It's funny, yeah, that's another part I didn't think about too. I had a meeting this week with somebody, literally it's a student that had a startup idea, it's a grad student, it is out now. And it was it was just getting started, $2,000. And he called for this meeting, and he came to meet with me this week, and he was very nervous. I couldn't figure out, because the meeting was going great. And I said, well, what else can I do for you? And he said, well, I have a problem. He goes, we just raised another chunk of friends and family, and I have this convertible note, and it's due next week, and do you really need how do you want to get paid? And I'm like, what are you talking about? It's 2000, no, just give me a new thing, we'll extend it for another 2 years, I don't care. I don't even know I had the thing. Again, why I call it a nonprofit. It was a student project, I didn't care. But it freaks out the investors, or the founders to have that stuff hanging out. 2,000 is nothing. If you have a $50,000, and I have a few of those, because a lot of our early deals we did here were convertible. Actually, most of them are. And those do hang out there waiting to get converted.
And will some of that be answered? You were talking that you're going to discuss later about choosing your investors. So if you're careful about who you're allowing to invest, some of this answer.
That does happen. Well, this is where this chart is. So it's a great segue. What time are we supposed to go to, Carolyn?
So we have till 5. So
Oh, okay. All right.
yeah, there's time.
Okay, so these numbers move up and down, but this is literally the class you have. So, in the early stage stuff, and again, look at where we're talking. This is the West. This is the Austin chart of 100,000. You got angel investors. Make that $500,000 to $1 million right now. You can get bootstrapping family and friends, incubators, and angels. A lot of people are doing their early stage stuff all off of the back of accelerators and competitions. Actually, if you guys know Zelfa Health, who's in here, it's one of our students, they've raised a ton of their money. I think they've lived maybe almost 2 years off of winnings from business plan competitions. So that's a valid way to raise money to do this. Then as you go higher up, you have early stage VCs and then angel groups. Angel groups are a little funky. We put them more here up here with the early stage VCs. You probably could put seed in the middle here. Why do we say that? Because angel groups are the worst of VCs and the worst of angels all put together. It's basically angel experience with VC herd mentality. Anybody dealt with any of these? Oh my God. There's nothing more frustrating to have two partners two angels go, I love this, I'm in. And 3 of them go, this is stupid. Don't you see this problem? And they're all gone. It's like you only take one person to go, this is a stupid idea, and they just disappear. But if you get them, they're nice. But because they tend to invest as angels in groups and clusters, and there's usually some milestone of you have to have so many before the group does the investment, they really fit more up in here than down here. You may be able to peel 1 or 2 off and get it, and if so, then they're true, early seed stage. And they really are the startup guys. Then as you get higher here, you move into late stage VCs, debt equity, and debt equity and private equity. The thing about private equity is really interesting. If you have a profitable business that can generate, or a prospect of a profitable business that can generate a lot of free cash flow, a PE firm may be a better candidate for you than a VC. Because remember, what a VC wants is they want to be able to have some type of an event that's going to get them a 5 to 10x, they'll all say 10x, but a good return on their investment. The PE guys are trying to get healthy growth businesses that they can either put with other businesses or put cash behind to get more cash out of the business. They don't necessarily, or what a lot of them do, is they borrow against it and have cash flow to put money in their pockets. So a free cash flow business, a business where you can generate a lot of below the line profit, may be way better off with a PE firm than with a VC, because they're going to be much more aligned to what you're doing. And the problem is that PEs are a little bit harder to find. You have to go to some of the forums where they pitch to them. A lot of times it's reference based, but I actually like PEs a lot better than these guys if I have a really healthy business, because I know they're not going to be looking for, an instant, IPO or M&A or things like that.
Are there some examples where companies have gone from seed to PE and completely bypassed this VC thing?
You mean from here to up here?
Yeah.
Did WB Edge take VC? Do you remember?
Yeah, they did.
They did. I'm trying to think who else. There are some though. There's some ones recently. I just don't know. You have to look and see them. But I mean, you can go right from. What's your profitable? Well, a lot of the CPG things are having, like Sienta Foods. I'll bet if you go look. I think they're just PE. And same with Kinder Scott. I think was that way. A lot of the CPG tend to be PE. The other thing is they usually are smaller revenue companies. 50 to 100 and 150 becomes a really nice PE target, where a $50 million business may not be that interesting for VC. We had a guy from NEA here, a friend of mine, who said, I'm looking for $1 billion. I want $1 billion businesses. I want to see an ARR that gets me to $1 billion in 5 years. Kinder Scott's never going to be that. But if that's the only measure you use, she would never have gotten money. She got a PE firm because they realized how much cash flow. $150, $200 million firm like that, that's a great business that is generating a lot of cash. So that's where PE makes sense. So, and your business may actually be a good PE target if you can start getting good cash out of it and show how with that money, you're just printing cash. Because remember, the big thing is they want the cash. They want to know that there's a cash outlet. Where VCs are looking for, market valuation, they're looking for an M&A transaction, something like that. They're not, I kind of break it down to like, there's investors that are really happy with dividends. They're conservative. I just want to know I have a return. In some ways, the finance people get mad if I hear me say it, but debt's in some ways a dividend. I just want to know I'm going to get my percentage every quarter and fine with it. You get PE guys that want to know there's a lot of cash available, and the more they grow it, the more they can get more cash out of that business, and they can leverage it to get more cash for themselves and for their investors. And at the highest end is VCs, which are the most riskiest of all, because they're looking for their big return. So, and it's no different if you look at the equity market. People that are conservative and want dividend, slow growth but dependable companies, all the way to people that are doing the pink sheets hoping that the penny stock goes to, $1 million. These are the two extremes. In the searching stage, you should be looking at those accelerators, incubators, individual angels, friends and family, your own money. Once you get to the point where, and so part of, to tie this back to the early piece, maybe slightly before first customership, but not much more, is where you're here. Here is where you hit first customership and you start getting line of sight to your assumptions and to where your break even is, because this is where you're starting to build a business. And here's where you do the end, because you now know what your 3-year or 4-year pro forma looks like and how much cash you're going to need to grow a crap load of customers. And this is where, if you notice, this matches really well to that pro forma piece I talked about. This, here is when you're working to get, you need enough money to get you to your first customer ship, your startup cost. Here you need enough money to get you to your break even. And then here is where you do, you go for your later runs. That's really how those matter across.
Are there any sort of like broad revenue or growth numbers that you could attach to each round, or does it kind of depend on where you're at?
No, I mean, there are some rules of thumb you can look up and just see, but I'll tell you, I think the rules of thumb are really dependent on the market you're in. I think California has a very different view than we do, and very different than Boston does. Our numbers are, it's just, I just think it's very different. example, when HomeAway went, I think they had an $80 million, I don't remember what number it was less than $100 million, something. They were huge here. And the guys on the West Coast were going, that's like first quarter of the startup for us, you know, we're putting time in one. So I think it really depends on your market and who your investors are. Any questions on that? I think that was it for that one. Was that helpful? Okay, let me pull up this other thing. Let me pull up the table. Like my cursor. All right, so it's maybe a little bit hard to read. Let me see if I can blow it up. This is super hard to read. Is that better? You need more? One more? How about that? There we go. Okay. So these are Austin-based VCs. These are who we have right now. Where they invest, here's the principals, and this is the last round we have that they raised. This is what we're updating right now is this. So, so the last time we updated this was January of last year, and we're in the middle of redoing it. But if you notice, there's not a lot of really big funds in our last round. To put it in perspective, somebody have a, yeah.
You should add Trammell. I think they had their first close.
It may be down below. Actually, Trammell's down below because we haven't updated it. I think Trammell is, so here's non-Austin VCs.
So I think they're all here today. I know that.
What's that?
I know.
No. I think they're in. I think we had them in the raising because we just haven't updated that yet. So non-local VCs, institution. Oh, that's type of PE. So one of the things that's happening is these are all the people over the last year. Most of these, last year the part of this was about here. These are all external VCs that are now investing locally with the local guys. It's a really big number. You see that investments. And I just saw Turkey just got another one. I just saw this week. I have to go look. What's pledge funds? You see it here. Travel. So they closed it. We just hadn't updated it at first close. Awesome. So thank you for telling me we'll update it. Arena Growth Partners has moved out of fundraising to they're just a pledge fund. They both got jobs. You know, if they get a good deal, they'll take it to the people they know. But what you see, if you saw this last January, we're going to do a side by side. It's way better than it was a year and a half ago. And even this one you'll see up here. I think I have this got to be updated. Oh, I'm missing. I must have proved wrong one. I had. Oh no, it's no. I'll show you. Don't laugh at it. Oh come on, you know. And that's why I killed you guys. Oh, that was weird. Sorry. Yeah. True wealth. Private equity. So here's a bunch of them that are here. Blue Sage, Centergate, family offices, Acacia Partners. So there was just an article that came out, I think this week from Austin Inno about Q2 numbers were down for investment, but the four more active were Live Oak. I think it was Live Oak, S3, Acacia, and one other one. You can go look at the report. There were four that were active. Acacia is a family, it's a family fund office. $2 billion under management. They manage 4 family funds. So, strategy capital. So here's some of the guys that do venture elsewhere. Here we go. This is what I was looking for. So this is one that just look under now raising. Lance has got his 24 million, and it got a lot of national news off. You saw that. So Next Capital just got announced. They've raised 24 million, their whole fund's 75 million. You know, 75 million is an A round for a West Coast company, just to be honest. So, and remember, they're only, when you have to think about, when you're thinking about the investors, you have to look at their available capital. So one of the things I would tell you, this is my other part of this, I really want to push. If you want, you can go up and down. So different groups. We're working to get this published like as fast as we can. I really strongly suggest going and looking at Crunchbase and doing a search when you're thinking about meeting with somebody. And I tell people this all the time. Just like you wouldn't hire somebody without doing a background check and characterizing them, and you wouldn't want to go do a big customer visit without knowing about that customer, you should not meet without an investor without understanding them. How much they have, how much assets they have under management, who they're investing in, who they invest with. Really important, because if you piss, they may not have a lot of money left, but you piss them off, they may be partners on board with a bunch of other companies they co-invest with, and you probably have lost the other ones as well. So, and one of the biggest mistakes I see entrepreneurs make is they just take meetings, they're so happy they get a meeting, they don't do the homework. You really should never go into those meetings without understanding a lot. Between LinkedIn, Crunchbase, PitchBook, if you have access to PitchBook, and the internet, there's a lot of information available about these people.
So what's your take on, there was a blog post a while ago that essentially boiled down to don't meet with associates.
Well, that's like saying I go to the doctor and never meet with a PA or a nurse. It'd be great, but it's really hard to do that. It's really at the, it's a question of, do I get to see the doctor or not see the doctor? It's the same thing with the VC. If you're going to NEA and you go, sorry, I want to deal with a partner, you're never going to get that. If you can not do it, that's fine. But you realize when you read these articles, they're written by somebody that's already a serial entrepreneur. Now if Alexis Ohanian, who did Reddit, wants to go pitch, he can say, I'm not going to be with an associate. Brett Hurt can say, I'm not going to be with an associate. If it's your first time, maybe even your second time, and they don't know you, you won't even get a call back. So, you do that. And here's the other thing. If you are going to meet with an associate, treat them like they're the partner, because they're the gateway to the partners. And then when you meet a partner, realize that partner doesn't make the decision in most firms. It's usually an investment committee of the partners, which means you got 3 gates to get through. So I'm not a believer in that. I mean, if you can, that's awesome, but I just don't think it's really practical. That's like, I love when they get those, because I know I've seen those too, and I've heard those, and like I've seen the, I don't even bother bringing a presentation or a pitch. If they can't get my idea off the talk, they're not going to get my, I don't want them to invest in me. Yeah, okay, thanks, Mark Zuckerberg. But, other than that, they're just going to laugh at you. Here's the other thing that Tom Ball really woke me up about this. These investors only have so much capital to invest, and they get hundreds of deals. So for example, I started at Ashton Tate, which was a software company. We had 400 on average submissions for us to purchase a company a year. So my team's job was, we go and vet them. We were only going to do maybe 2. Of the 400, maybe 50 of them were phenomenal. We still only had the capital to do 2. So if they pass on you, it doesn't mean they don't believe in you. You may just have gotten the odds that it doesn't work. But also it means if you did get picked, you had really good luck, because there probably were 50 good deals. And Tom Ball said to me when we did a panel here, I was actually at a Capital Factory event. He said, I maybe will do 5 to 10 deals a year, and I see hundreds of pitches. And everybody thinks that theirs is the best deal. But the reality is, I got a lot of best deals that are going to give me a good return. I'm going to pick one. It's not just going to be about the product, but do I like this person? Do I think that it fits with my portfolio? Can I get other people in? I mean, so what they're thinking about is very different than what we would think about, on the entrepreneur side. Which is all the more reason why you want to make sure you know what's going on. But I started to say that I did that project with Steven Strauss and came out of an argument. The argument happened because this is going to be kind of tied in, this piece about the type of investor. My first project I did was based on a discussion that Josh Baer and I had about 5 years ago, when we had all these startups,
And CTAN and all these people and us partners were pissed because AV had gone away and we were having a hard time getting follow-on investments, but we were required as partners to put 2 investments in. And we knew that there weren't that many VCs. And Josh said to me one day, I've seen no empirical evidence that we have a lack of capital problem. And at the same time, Bob Metcalf was saying, we don't have enough good, he still says it, we don't have enough big thinking investors or entrepreneurs. So I said, okay, great, there's an empirical problem, I'm going to do a research project. So I spent about 1.5 years with another researcher, a finance professor, and we did a survey a demographic survey of 9 major metro areas that accounted for about 90%, 80-some% of the total amount of venture capital invested in the United States in 2014. And we counted their sources of capital, their VCs, their angel groups, only institutional level, and their debt holders. And we had 144 total in Austin. They had just about 800 in Silicon Valley. And Silicon Valley that year had $24 billion invested. We had $640 million total for all of Austin. It wasn't a linear track. It was this big pogo stick. And weirdly, it was very common. The 3 big markets had these big numbers. They were about 70-something% of the overall market. And all the other 6 were well below. So it was the 3 and then the 6 below. And I did this study for here, but really my clients were Austin Technology Council and the Chamber. And the Technology Council said, we really want to release it. We hadn't done all of our work, and we hadn't really socialized it yet. So I said, well, Bob Metcalf's going to come out and say this is a bunch of BS. So I got to show it to Bob first, and I want him to look at the data because I need him to at least go, this is a good methodology, because you don't want to be going against Bob Metcalf. And Bob looked at it and he said, I think I have to agree with you. And I said, great, why? He said, you found a new use for Metcalf's law. If you go plot it, I will bet you it fits a curve. And sure enough, it fit the curve perfectly. Well, not pretty good, pretty. I mean, it's scatter plot right around the curve. Metcalf's law says that the value of a network is proportional to the square of the number of nodes in a network. So it's not a linear, it's an exponential effect. It explains why somebody with 100 users is not slightly less valuable than somebody with 1,000 users. They're way less valuable because those 1,000 people the people with 1,000 users have a bunch of 1,000, connections in there, and that's the social net. And Metcalf's law explains social network effect, and it really works with that thing. So that was a study, got lots of press, got all over. It was really awesome for a brand new PhD. It was like super awesome. And Steve Strauss said, "That's a bunch of bullshit. Your numbers are bullshit." And I'm like, "What are you talking about?" He goes, "I want to see your data." So I showed him all of our things. He goes, "That one's dead. That one's dead. That one's dead. That VC's gone. That one's dead. Laura Kilcreasis is still listed as alive, and she's in Canada." And I go, "Well, what we did for ours is we looked at the nodes of the network. We didn't look at active investors because they still take meetings. All of these people still take meetings. Arena Growth Capital will still take a meeting. And even though they don't have capital, they'll refer them to other investors." So from our research, it was still the network. But he said, "Yeah, that's not helpful at all. Because investors or entrepreneurs are pitching to these people. We need to tell them who really has money." And that's how this came out. And that's why we've separated those funds, like Trammell was down below. Because even those guys are taking, we're taking meetings when they haven't, what's the female, True Wealth. They were working with us from the very beginning. True Wealth was taking meetings well before they got close to closing their meeting. But they really didn't have anything to deploy yet. But they were building their portfolio. So that's what we've done with that report. And that's a whole big story to tell you. You really have to do your own research and know your investor candidates before you go in, so you don't waste a lot of time. And people do waste a lot of time, and it's not just your energy time, but those people have those big networks. And if they don't like you, or they think you're bogus because it's not their specialty, that will get out, and you can really cause yourself problems. So that was kind of like what I had. I don't know if that's all. Pretty awesome. All right, this is fun. Thanks for letting me do that.